Hello friends, welcome to a digital blogger. Today we are going to talk about some tips, some basic techniques that can help you to become a smart investor, basically help you to identify yourself as a differentiator among other investors. It is going to be interesting for you, helpful for you. Let's check it out. Before we move ahead, we need to understand who exactly is an investor. Now, investor is somebody who is looking for a long-term game. I'm going to put in money today, but I am not looking for the return right away or in few weeks or probably in few months. I am probably here for a few years, maybe for a few decades as well. But at the same time, I am going to put in money in the kind of products that can give me good returns after that particular duration. It could be 5 years, it could be 10 years, it could be 20 years for that matter. So basically an investor is obviously not a trader who is looking for a short-term quick gain. Somebody who is like trading on an intraday level at the stock market, putting in some money now, getting it money, getting the return right away. No, that is a trader. So if you are somebody who is looking for some sort of investment for a long-term duration, then these tips are applicable for you. Well, talking about tips, the number one tip in this particular series is you have to start early. Now there is something called a compounding effect. It applies amazingly on investments. If you start early, I'm talking about your first job salary days, then the kind of returns you can expect in a few years, probably 5 years from there or 7 years from there, are really high as compared to if you start very late. That's the magic of an early start. With inflation in place, every year you see that in India we get around 4 to 5% inflation, which is a good number. We were having 10% inflation a few years back as well. So if your money is being invested, then not only it cancels the impact of inflation, but it also produces increasing returns on the capital. So you have to start early without any doubt. Next point in this particular series is you have to know your requirement. What exactly do you want? While you're investing, what are you going to do with these investments once they get mature? Alright, it could be something like a children's education. It could be you want to build your own house. It could be getting to start a business 10 years down the line. It could be anything. Once you know where you need to put up the money and when exactly would you need that money, accordingly you will put out specific products and you will put that money into those products accordingly. Different people have different aspirations, and money is something that is obviously needed in different phases of life. So if you are putting your hard money into an investment plan today, then there must be a sign in your head for its future usage. Going ahead, choice of investment products. Now, Indian financial space today is one of the most interesting and dynamic ones in the world market. There's a huge variety of investment products. It could be equity, it could be mutual funds, PPF, gold ETF, bonds, currency, you name it, they have it. You must have some basic understanding before you put your money into that particular product. It's something like buying a mobile. So once you want to buy a mobile, what exactly do? You research, you check out the specific features, and once you like a specific model, only then you buy it. Exactly in the way, once you're going to invest into a particular product, you need to know where you are putting your money, what kind of returns, what kind of values that particular product can bring to you in that particular duration that you are looking for, and only then you have to put your money, not before that. And different kind of investment products can give you different kind of return percentages. Now, for example, mutual funds can give you a return of 5 to 10%. Gold ETF can give 6 to 12%, currency 3 to 10%, equity 5 to 15%. So the kind of investment product you choose is directly related to the kind of investment return you are looking from. Next up in this list is you have to understand yourself. You have to see what is your risk appetite. How much risk can you take? It's not like I want that kind of return, but I can't risk it. Well, you have to risk if you can high returns. So it's pretty simple. For example, putting your money into the stock market is obviously much riskier than putting your money into the fixed deposit. But your stock market can give you much higher kind of return percentages as compared to any particular fixed deposit can. So it's pretty simple. You have to understand what kind of a trader or what kind of an investor you are, and based on that you have to make a choice. it goes without us saying higher risk may bring higher returns. It's kind of cliche, but when it is applied, then you know what exactly it means. Next one is diversify investment. So people, you must be hearing a lot, don't put all of your eggs in the same basket. Well, people say that. Well, at the same time, you have to understand, if you are sure that you're going to put your money into the specific investment products, you have to diversify those investments. It could be putting your money into FD, putting your money some into gold, some into stock market. Basically, you need to choose, depending on the kind of capital you have, you need to choose few investment products, and allocate your funds accordingly. You don't have to equalize all those funds into those investment products. It can be, some products can have higher capital, some can have lower ones, depending on the risk appetite each product brings. But at the same time, you have to be sure that you are not putting everything into one or two segments. You can be choosy, but you must make sure a detailed research is being done before you finalize the rest of segments you are looking to invest in. Tip number 6, invest consistently. To stand out as a smart investor, one of the most important factors is to make a habit of investing. Whenever you feel a specific amount that is potentially non-usable for that particular moment, put it to work, let it do the talking for you, invest it. This is a regular habit of yours that can do wonders and help you stand out among other fellow investors. Furthermore, don't worry about the amount value. It could be 5,000, 1,000, 10,000, it could be any particular value. Even if you invest with small money chunks, overall investment value after a point in time will be decent enough. For instance, if you get a small raise or a yearly bonus, make sure you have something in mind already running to put this chunk into work for you. Number 7, don't just follow others. It's as simple as it is written. You will find a lot of self-made financial gurus. You might find them on TV, on journals, newspapers, proclaiming you that, okay, go ahead and buy this, go ahead and sell this. Well, you can hear them. You don't have to necessarily follow them. You must do your own research before putting in your money while you're buying it or you are selling any investment product. So basically, the point is very, very simple. If any of your friend, if any of the fellow investors, or if any technical guru is telling you that you go ahead and put this money into this particular investment product, no, it's not that simple. All kinds of products, all kinds of market situations are different, and once you start following them, well, you might lose, you might gain, but at the end of the day, it's your money. You should know where you are putting it. Next up in the list is keep educating and keep learning yourself. Now, irrespective of the fact that you are a 20-year-old college going student or you are a 55-year-old retired person, if you are an MBA, if you are an engineer, it really doesn't matter what kind of education background you carry. Once you're putting your feet into the financial space, once you're going to invest your money, you have to make sure that you are continuously learning about new kinds of investment products, new kinds of returns, new kinds of expectations these products bring into the world market. You can refer a few books, and then you can make a habit of going through different kinds of journals. There are so many financial blogs, there are so many YouTube channels for that matter you can subscribe to, and obviously there are newspapers that you can refer. But all of this is a secondary sort of research that you need to do. At the same point, like we discussed in point 7, you must do your own analysis at the same time as well. Don't keep an ego that I know everything. There is no person who knows everything in the world. Even Albert Einstein doesn't know a lot about Indian culture. So there is a lot that is left out for him as well. So if you are new to financial space, then start from scratch, start from zero, and then basically make a habit out of it. Finally, you have to monitor your portfolio. Well, this goes without saying, but we have to mention it explicitly. 90% of the people, what they do is they buy, let's say, a mutual fund for 2 lakh rupees, for example, and they say we're going to wait for 5 years, and they forget about it. They say this is the end of the road for now. I'm going to see how it works out for me later. No. Simple answer, no. It can't go that way. You have to consistently look how exactly your mutual fund investment is trending on, how it is performing. Is there any other opportunity you can pen into? Is there anything wrong with your investment you have to figure out? Monitoring your portfolio after a certain period keeps you aware of the trend of your returns, and at the same time alerts you of any potential losses within that particular segment. Considering these alerts, you may choose to pull out or stay invested depending on your risk appetite, market situation, and capital in question. So the first step that you need to take in this direction of investments is open a demat account. You have to do it, especially if you're looking to have investments in equity market, currency. For these days, mutual funds might also you can do through a demat account as well. So if you want to do that, you can check out this link, digitalblogger.com/free callback broker choice. Put in your details there and we will set up few callbacks for you absolutely free. This is it for the video. We covered few tips. There can be a lot more, but if you consistently follow these, you will definitely be a smart investor. Thank you so much for watching the video. If you liked it, go ahead and press the thumbs up button. We'll really appreciate it. You can also subscribe to our channel, Digital Blogger, at YouTube for similar videos in the future. Thank you so much again. Bye bye.